Chapter 12, Accounting for Partnerships. A partnership includes two or more owners whose business is often a small retail, service, or manufacturing company. The partnership is a legal entity that passes its net income down to the owners, the partners. Mutual agency is characteristic of a partnership, whereby the act of any partner is binding on the other partners, so long as the act appears to be appropriate for the partnership. The partnership has a limited life. Dissolution occurs when a partner withdraws or a new partner is admitted. Unless established as a limited liability partnership, each partner is typically personally and individually liable for all partnership debt. The partnership agreement specifies names, capital contributions, rights and duties, as well as the basis for sharing net income or net loss. It also includes the provision for withdrawals and the arbitration process in case of disputes. The procedures for the withdrawal or addition of a partner are addressed in the partnership agreement. In the event a partner dies, the agreement states the rights and duties of the surviving partners. A. Rolfe and T. Shea, who form a partnership named U.S. Software, have the following assets prior to forming the partnership. The book values of the assets total $11,000 for A. Rolfe and $12,300 for T. Shea. On the other hand, the market values of these assets for A. Rolfe and T. Shea are equal at $12,000. The journal entry made by the partnership to record the investment in the partnership made by A. Rolfe includes an increase or debit to cash. Office equipment is debited for the fair market value of the equipment, $4,000. The partner capital account for A. Rolfe is increased, credited, for the total of $12,000. The partnership records the following journal entry for T. Shea's investment. Cash is debited for the amount of cash. Accounts receivable and the related allowance for doubtful accounts are recorded at fair market value. And since assets increase with debits, the accounts receivable is debited for the fair value of $4,000, and the contra asset account, allowance for doubtful accounts, is credited for the fair value of $1,000. The partner capital account for T. Shea is credited for $12,000. Partnerships divide net income or loss according to the partnership agreement. Kingsley Company agreement calls for salaries of $8,400 to King and $6,000 to Lee. Interest allowances of 10% on beginning of year capital balances and the remainder equally. King's beginning of year capital balance is $28,000 and Lee's is $24,000. The partnership net income for the year is $22,000. Given this information, a schedule distributing the net income will be prepared on the next slide. The schedule of the distribution of net income begins with a salary allowance of $8,400 to King and $6,000 to Lee, for a total salary allowance of $14,400. The 10% interest allowance for King is $2,800 and $2,400 for Lee, for a total interest allowance of $5,200. The total salaries and interest is $11,200 for King and $8,400 for Lee, resulting in $19,600 for both partners. The remaining to be divided is $2,400, computed by net income of $22,000 minus the $19,600 that has already been distributed through the salary and interest allowances. Since the partnership agreement calls for net income to be split 50-50, King receives 50% of $2,400 and Lee receives $1,200 as well, for the total remainder of $2,400. Note the total division of net income does equal $22,000, the amount of net income. The journal entry to record the allocation is recorded as a debit to income summary for the amount of net income, and credits to Sarah King for $12,400 and Ray Lee for $9,600. If the net income were only $18,000 instead of $22,000, the distribution schedule would be modified. The total salaries and interest would be the same as before, but there would not be a remaining net income, but a remaining deficiency of $1,600 calculated by net income of $18,000 minus the total salaries and interest of $19,600. The deficiency is split 50-50 between the partners, with King receiving $800, as well as Lee receiving $800. The total remainder represents the deficiency. The division to King and Lee does total the net income of $18,000. The liquidation of a partnership ends the life of the partnership. The partnership sells the non-cash assets for cash, resulting in realization. The steps in liquidation include selling the non-cash assets for cash and recording a gain if the cash received is greater than the asset's book value, or a loss if the cash received is less than the book value of the assets. The gain or loss from the sale of non-cash assets is allocated to the partners based on their income ratios. Next, the cash from the sale of non-cash assets is used to pay off the partnership liabilities. Finally, the remaining cash is distributed to partners based on their capital balances.